Hey everyone, and welcome to the Rareliquid podcast. Today's guest is Kevin Jiang, who has an insanely stacked finance resume. He started off at Goldman in banking, then went to Apollo for private equity, was on the founding team of SoftBank's $100 billion Vision Fund, worked as a hedge fund investor at Soros, and now is the founder and CEO of Mangusta, a venture capital and growth equity firm, all of this before the age of 35. Now, most people aim to work in one of the buy-side industries, but Kevin has literally worked in them all, so I felt like I could have interviewed him 5 times and still not run out of things to talk about. In this episode, we cover a wide range of topics, including what it's like to start a VC firm, stories about SoftBank's founder Masa, how he implements lessons from his hedge fund days as a VC investor, and a whole lot more. Now, before getting started, if you're listening to this episode because you're interested in breaking into private equity, you may want to check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and be sure to use my code rareliquid to get up to $500 off, and I'll leave information for everything discussed in this video's description. All right, hey Kevin, thanks so much for joining. And first thing I wanted to just ask is if you could walk everyone through your background.
Sure, happy to. I'll keep it quick and then we can dive into all the different elements over the course of this. So I'm originally from Silicon Valley, Chinese American, grew up in a town called Cupertino, which a lot of people may know as like the birthplace of Apple, and studied on the East Coast. So I went to school at Harvard, and then I've been I started out in more traditional finance, and in particular Goldman investment banking. And then I joined a private equity firm called Apollo after that. And then for most of my career, I was at SoftBank as one of the early team members at the Vision Fund. So I joined in 2017, and I was there until about 2 years ago, where I started my own VC fund called Mangusta Capital. And Mangusta means mongoose in Italian. There's a very interesting backstory on how the name came to be. But we're an early stage AI-focused VC fund. We invest primarily at kind of Series A and Series B, based here in Silicon Valley, which is where I live now in SF. And we invest across all kind of layers of the AI value chain, everything from applications all the way to infrastructure and hardware as well. So been doing that for about 2 years. We started our first fund in 2024 and going to start gearing up for a potential new fund probably in the next 6 to 12 months. So really excited to be here, and thank you so much for having me on the podcast. I have always been an admirer of the work that you put in and the content and that you do. So finally excited to be on here.
Yeah, thanks, Kevin. I appreciate that. And I think everyone who's listening today will have a lot to learn from because, as you've probably seen from my channel, I cover like banking, private equity, hedge funds, venture capital to some degree. And it's rare to have a guest who has dabbled in all of these industries. But before we get to any of the professional stuff, I actually had watched some of your other interviews, and one story you talk about, and something I want to kind of get into before we go into any of like the professional stuff, is just kind of how your story was, or how you were kind of shaped when you were younger. One thing you kind of talk about is how your parents came to the US with just $200. It's a lot of immigrants, I guess, like for myself too, my parents came to the US without too much money as well. But I'm wondering for you, like, how did that shape who you were growing up, like in high school and in college?
Yeah, no, it's a great question, right? And I think it's the beauty of this country, America, that people can come from anywhere in the world and make a beautiful life for themselves and their family. So, my parents, they grew up in China. They came here for grad school, actually Canada in particular. And so when my dad and my mom first moved to Canada, they literally came with a suitcase and $200 in their pocket, and they made do with what they had. I remember my mom would always tell me the story of like when they went grocery shopping when they were young, like they would go to find bread that was like on sale, or like they would go, purchase whatever was kind of the cheapest option available. And now we have like, Whole Foods. You can go get really expensive. You could go to Air One and buy, $20, $30 smoothie, which sometimes is crazy in my mind, just because of like where I came from and my background. But it was obviously a huge influence in like for myself, like thinking about financial independence and the importance of kind of building a good financial foundation for myself and my family, which has also motivated me a lot in terms of like career aspirations and building as well. So I think that kind of emerging underdog like immigrant mentality has really driven a lot of who I am and what the kind of passion that I bring to the work that I do. And it's also something that frankly we look for in a lot of founders as well when we're kind of deciding who to back. Like you want to feel like there's a hunger and a drive that this founder has for whatever reason. It doesn't have to be that, they came from an immigrant background, but there's something that they're out to prove and they have a chip on their shoulder. And that kind of goes back to the mongoose mentality as well. Of like our firm is literally the symbol is like a mongoose, and we want to find people who are hungry, punch above their weight, and they're kind of like an underdog in what they're trying to do.
Do you feel like that background has caused you to be risk averse, or is that something you fought at all as you were growing up? Because I can imagine, and just also seeing from your first job, right? You go into banking, which is a little bit more quote unquote safe, but of course tough to get into. And then now when I compare it, you're in an industry that's known for being risk taking, right? You're taking a lot of risk at times by investing in these early stage startups. So I guess the question is more of how has your approach and thought process to risk changed from when you were younger up until now?
Yeah, I mean, I think you bring up a very interesting dichotomy, right? Which is, as an immigrant, kind of coming from an immigrant family, the idea is like, oh, you want to find like a high-paying job that will make sure that you feel comfortable and you make enough money, right? And so I think you're right that in the beginning of my career, I started with slightly more, I would say, risk averse and more kind of stable kind of career paths, which is joining an investment banking program, being an analyst for 2 years. And then I joined a private equity firm, all jobs that pay quite well from coming out of undergrad as a, fresh, newly minted, graduate, right? But then I think the switch that flipped is that at some point, I think you make enough that you've built a financial foundation you feel comfortable with. And then that point was one at which I've decided, well, hey, I can keep doing this and, I could stay at SoftBank or join another private equity firm or growth fund and, be a managing director or partner and obviously make good money as well at that. Or you can kind of strike out on your own and start something of your own. And obviously the risk is higher, but the opportunity, upside opportunity is also higher too. And I think for me, it was at a point, maybe call it 3 or 4 years ago, where I felt I'd built a bit of a financial foundation for myself where, I bought a place that I felt very comfortable with. I had some savings in the bank. And I knew that, if for whatever reason I didn't have a job for a year or two, I would be fine. And that's the point at which I feel like I wanted to kind of take that switch and just say, hey, let's take some risk. Let's do something really out there. I could start a fund, you could start a company, but let's do something that I'm really excited about. And I feel like there's going to be a lot more upside involved. So I think there was definitely a bit of that mindset shift from kind of the beginning of my career to kind of where I am today.
And what would you say was what shifted your perspective? Because you kind of mentioned, that you have built some savings, and so you had like a financial foundation. But was there? We're kind of getting ahead of ourselves a little bit as well, because there's a lot to go through, but was there some kind of shift that happened in your mentality or some moment where you decided, okay, I'm not going to go the route where I'm just going to stay at SoftBank or work in private equity. I'm going to start my own fund?
I don't think there was a specific like mindset shift moment per se, but it was also like I also have this very firm belief that life is very like serendipitous in that opportunities come and go from your life that you may not expect, and you kind of just have to like grab on at the right time if you feel like it's the right opportunity for you. And so, frankly, I guess we're getting a little bit ahead of ourselves, but there was a point when I was at SoftBank where I started thinking about joining an earlier stage kind of fund where maybe it's a fund one or fund two, like a relatively new firm where they could bring on like a senior person, and also talking to potential investors or LPs in venture capital funds and seeing if there would be an opportunity for me to raise capital. And I built a very strong relationship with the family that is now my anchor LP in the fund. And so when the opportunity came around and they basically verbally committed, say, that they would anchor the VC fund I wanted to start, it was kind of like the opportunity is here in front of you. You've got to decide, are you going to take this opportunity and run with it? Or are you just going to continue down whatever other path you're still going? So in some ways, I think sometimes life gives you a fork in the road, and you just kind of have to decide at that point, like, do I take this opportunity and run with it or not? And that was kind of where I was left, call it 3 years ago, after I'd built this relationship with my anchor family office in the fund.
And what did that feel like? Because I'm also thinking at a smaller degree to people who are I guess, familiar, I guess, a bit with my story, where I left banking when I was around 25-ish, when I had just finished, or it was in my third year in banking, and I didn't have much lined up, but that was like one of the big risks I've taken ever in my life. And where I didn't have my next step planned, and I decided to eventually start my own business. And all of that to me was very thrilling, but daunting at the same time. So I wanted to know for you, like, how did it feel to transition from having this very set out kind of path? And then can you walk us through maybe, I don't know if you remember your day one or week one of like starting your new fund and what that was like?
Yeah, I mean, it was crazy because at the time, I also had a lot of life changes at that same time. So I'd actually gotten married. We got a dog, so we had a puppy that I was like training at home and potty training at home. And then we had also just bought a new place that me and my now wife were going to move into. So it was actually a crazy hectic time. That when the fun started, but I remember just being at home and like just trying to figure out everything, right? Like setting up the legal entities. I was on the phone with the lawyers all day figuring out different taxation schemes and what's like the most optimal way to set up this fund, what's the process of like getting all the documents signed up and filing the documents with like regulators or the SEC. And so I just remember like the first few weeks, I was just sitting at home, just on the phone all day, trying to figure out all these things I knew nothing about. I definitely think it felt kind of overwhelming at first, but at a certain point, if you have good advisors that are working with you, like our law firm, Oric, they were always available, so I could like call them anytime, talk about anything I had questions about. We brought on like a fund administrator who does all of our back office stuff. And so slowly but steadily, I think if you have the right people around you that are helping you with setting up all these things and answering your questions, you feel a little bit more comfortable over time that like things are slowly working out and getting more and more kind of settled. But I think the first like month or two was definitely like chaos and just like, I don't know what I'm doing. And we're just going to kind of figure this out as we go along. And it's fine. I think it's part of the journey of like learning and of being like an entrepreneur yourself.
Yeah. I mean, would you consider that the first few months were more challenging, or did you find it more like in that following few months, or has the most recent few months, like what part of the journey has been the most challenging? It's been like 2 years or so since you launched the fund, right? Which is
Yeah.
still relatively a new fund.
Yeah, I would say the beginning actually, there's just so much like excitement and adrenaline that you feel in the beginning. I think it carries you through where you feel pretty excited about everything, and also like the freshness of like what you're doing and starting something, I think gives you a little bit of like a high that you kind of stay on for a couple months. I think the hardest part by far was fundraising. So call it the first year of when we started kicking off the fundraising process. And it was just a real grind because I was traveling a bunch all around the world. You're refining the story and you're refining the materials and figuring out what works and who you should be talking to. And it's a very uncharted and kind of lonely journey, I would say, actually, for fundraising for a first time fund, because it's unless you have someone that has gone through the process before, if you have a co-founder or advisor that can like really handhold you a little bit more through the steps, it's just a very like lonely and long and hard journey to fundraise for a first time fund. So that was probably definitely the hardest part. I think that as an entrepreneur, you always feel the need to like challenge yourself though. So for me, even now, right, I'm always pushing myself and pushing my team to like do as much as possible. To like, there's always more projects that we can take on. We always can bring in more investors into kind of the fold and collaborate with different LPs or different VCs. You can always host more events. You can also always do more social media, podcast stuff. So like for me, every day is a challenge, and I purposely want to like push ourselves to continuously challenge ourselves. But I would say like the hardest part of the journey is probably that first year of fundraising, because it's just such a unique experience and it's never easy asking people for money.
So let's say then that someone's watching this right now and eventually they want to start their own fund. I guess like it could take hours for you to even explain so much of the nitty gritty, but what kind of advice would you give them? And are there any stories also maybe that you could give us to portray just like how challenging it is at times or what it's like basically to raise money? Because I think a lot of people, even myself, when I see all these funds like raising a lot of money, even entrepreneurs, when they raise money, a lot of times they say that fundraising is extremely tough. But then we don't always know exactly what that means. So is there anything that kind of comes to mind?
Yeah, I mean, I can give you some like more concrete kind of data points, right? So basically, we were fundraising for about a year from call it like the fall of 2024 to the fall of 2025. And I think I should go through the records, but I know that I talked to at least 1,000 LPs. So whether it was Zoom calls, in-person meetings, I met with at least 1,000 potential investors for the fund. And during that period of time, I traveled probably for about like 40 to 50% of my time for that year was on the road. So I was traveling to conferences, like Super Return is one of the big ones. They do conferences throughout Singapore, Berlin, New York, Miami, LA. So they host conferences all throughout the world, was going to a bunch of those. There's other big conferences like that as well, that are hosted by other organizations. And then I was getting introductions as well from like friends of friends, former work colleagues. And so I would often set up a trip around, I'm going to go to Monaco for like a week. I'm going to go to London for a week and meet with like these 20 or 30 investors and just set up back-to-back meetings, right? So there was trips where I would be in, a city, and I would basically be back to back, like 8 meetings from morning to night, 1 hour each, where I'd meet like person after person. I'd sit in like literally a conference room, or I'd sit in like a cafe of the hotel and just have people come to me one after the other, right? And if you can imagine doing that for basically a full year, that's like the level of kind of, I don't know what you want to call it, hustle or grind that it takes to like meet so many different people. Because one of the things I learned during fundraising is your story and your thesis and what you're building is going to resonate with certain people and it's not going to resonate with others. And part of the process, at least for me, was figuring out who are the type of people this is going to resonate with and who is not going to. And I think you can only do that kind of by trial and error and collecting the data points, right? So we realized pretty quickly after meeting with a lot of different types of LPs, institutional LPs, family offices, individual angels, and high net worth individuals, that what really spoke to like what the story that resonated most was kind of as a first time fund, my background, the things I'd done resonated mostly with angels and high net worth individuals and some family offices and institutional LPs for a variety of reasons, including the fact that a lot of them got burned during COVID, had kind of stopped allocating a lot to venture capital. And also, many of them just couldn't really invest in a first time fund or even a second time fund at that. So we realized quickly, like, here's the profile that we need to target. And sometimes in like a 30-minute meeting, you can pretty quickly feel out whether someone's really interested in what you have to offer or not. And the goal is to like meet as many of those folks as possible. And they're going to kind of convert on their own timeline. Like there were times where I would meet with like a LP and we do a 30-minute call and it would be done after that. They'd sign the documents, they're in. They're people where I met 6 months ago. We did, many, many meetings and they kind of disappeared. They ghosted us for like 6 months. And then suddenly one day they reach out through the email and they're like, hey, I actually think I want to invest in your fund now. And then they finally, sign the documents. And so it's just a very like random, I guess the best way to put it is like a super random process, and trying to put some structure around it is helpful. But in some ways, I think it's also just a lot of luck and randomness and noise. And you just kind of have to keep going through and grinding through it with the expectation that like, if you put enough hours and effort into it, it will eventually work out.
So I guess a more personal question is, did that strain your relationship? Because you said you had like a dog that you were taking care of and you're traveling like 50% of the time. How did you manage like all of that? Or
Yeah, it's tough, man. I think my wife is obviously like super supportive and amazing person. My parents also like helped a lot, so they still live here in the Bay Area, and we would often like drop off our dog with them for a week if I was traveling a lot or if we were both traveling. So certainly like takes a big strain. But like I think there's an understanding between like me and my wife that like this is something that I'm super excited about, and being like a founder, being an entrepreneur is like it's a tough journey. So you've got to make some sacrifices, and I think having like people around you that understand and support that is also very valuable, right? Because it's not going to be a 9 to 5 job and journey. Like there's going to be late nights, there's going to be really tiring, frustrating days, and you want someone who kind of people around you that understand that and will like help support you through that, at least if not like operationally, then at least like emotionally as well.
right, yeah. I guess as you were talking about the most like frustrating times, and then I was wanted to just know if, and to close out, I guess the fundraising portion a bit, one maybe story of like the most frustrating moment or day, and then one of like the best days.
Oh wow, that's an interesting one. I think during like the most tough, like one of the most tough days was probably there was a very big. I think both stories tie in with like a big investor, right? Because I will say we have a lot of LPs in the fund. I think we have around 70 to 80 LPs in the fund, many of which are like angels and individuals. But the ones that like obviously stay in my mind are like the larger LPs, right? Because it's like the one that got away, that like the whale hunting in a way. So I remember there was one bigger LP that we had done a lot of meetings with. It was kind of like a London-based family office that had some like South African roots as well. And we had done, I think like maybe 6 or 7 like due diligence calls, meetings in person. I'd met him like 2 times in person, flew out to London, met for the first time in Berlin as well at a conference. And then after like 6, 7 meetings, suddenly they just like ghosted us. And so that was one of the toughest things because they said they wanted to potentially write like a $5 to $10 million investment in the fund, and those just really hurt because you feel like when you get to a point where you've done 6 or 7 meetings with someone, they're very serious. We put together tons of like materials and data room requests for them, and to suddenly just kind of like lose that, it just felt like a kind of a big blow. On the other hand, there are also like there was another big Korean investor. So the interesting angle is we actually also have a very strong Korean network through venture capital, friends from college and high school that I've known, and also just like a lot of the Silicon Valley kind of Korean network here we've built out. We actually have a handful of family offices as well as 2 institutional LPs that are investors in the fund. And I remember one of these institutional investors, which invested almost $10 million into the fund, like we had been meeting and chasing them for like a year. And so to finally close out the investment from them after a year of talking to them and similarly doing a bunch of diligence requests, filling out a lot of Excel files and writing up memos and really long like text write-ups about each of our portfolio companies and team composition and all this stuff, finally closing them a year later was obviously like a fantastic day, right? Because when you get one of these larger commitments as well, it's a very good way to build momentum with other investors you're talking to, because you can say, hey, we just closed this giant, LP, institutional LP. It lends a lot of reputation and credibility to like what you're doing and the fact that you actually were able to get someone like that, right? So I think those are probably like the 2 moments in the journey that I felt most kind of compelled by.
I mean, this sounds like so much work, and I don't know if this is true or not, but if you're constantly raising your next fund, then hopefully, I mean, I guess you tell me that the process gets easier and it's more efficient. But then I guess if you're spending all this time fundraising, then how do you manage the time to also actually do your other, part of the job that's kind of more important, which is actually investing? Like, how do you balance those two?
That is a really, really good question. And it's a super tough balance to strike. So I will say that because Fund One, I was able to more focus on fundraising for Fund One and a little bit less on investing during that period of time when we were just first starting everything up. I don't know if I've actually gone through trying to balance those two yet, which I think we're going to go through for Fund Two. So I'm not really looking forward to that because I agree it's going to be really difficult to manage and balance both of those, where we're going to continuously be investing out of Fund One and finishing out probably a few investments, and then at the same time starting to fundraise for Fund Two. So I'll have to let you know how that goes. But I think you're right. There's a saying in investing in venture capital or any kind of probably investing where you're starting a fund where you're always fundraising, because even when you're not actively raising your current fund, you're building relationships with LPs that hopefully could invest in your future funds. So I think the best way to do it is to always build a relationship as early as possible and to maintain that relationship so that the person already knows you even before you say, hey, we're just started raising Fund Two. Like, you've known me for 6 months. Let's chat more if you're actually interested in investing in Fund Two. And I think that's a far easier story than, oh, out of the cold, hey, first time I met you, but, we're raising Fund Two. I need to know within the next 3 months whether you're in or you're out. Like, it's a much easier to just have that Rolodex available that you've built over the years slowly and steadily. I think inevitably one side of investing or fundraising has to take a bit of a backseat. And in my opinion, if you're in an active fundraise for your next fund, I think the investing kind of has to take a backseat, which is an unfortunate sacrifice that I think kind of has to be made, unless you are a large institutional fund or a large enough fund that you can have like a dedicated IR team that does all the investor relations work, or you just split the work where it's like, hey, this partner does all the fundraising stuff, this partner does all the investing stuff, just so you can have like divide and conquer, right? But I think inevitably you have to make sacrifices on one side or the other if you have a really small team and you're a relatively new fund like we are.
So I feel like when I hear about what you're doing and all these different ways you're being stretched, I kind of I feel like I relate to it a bit, probably in very different contexts. Where if I'm running my own, small little operation, and I have to do all these things for. I mean, I even do our own accounting on QuickBooks, for example, as a small detail. And for you yourself, if you're a part of a larger fund, then people have like these specialized roles. But for you, you have all these different things that you have to be doing. This is more of kind of like just you personally. Rather than a professional lesson, but like personally, do you feel at any time like overwhelmed with all these different things that you need to do? And then if so, like how do you approach actually getting through your list of things to do? This is actually something that I deal with quite a lot. It's like, I have a never ending list of things that I do. I have to like prioritize. And sometimes honestly, I do get overwhelmed with all the things I have to do. How do you approach all of that?
Yeah, I mean, it's funny. I still like approve a lot of our wires. Like I don't do the accounting. We do have a back office, like a team, a third party vendor that does all of our accounting, taxes, etc. And we do also hire like legal counsel when we look at deals and documents. I think, for me, it's trying to figure out where we can offload efficiently things like, for example, some of the finance things that we need to offload. I think a lot of it's also kind of figuring out, are there things that I can bring on like a team member to help out with? So we do have a few kind of full-time team members that will take on some of these more kind of menial, like maybe more administrative, operational type of tasks. But I've figured out tips and tricks to like try, offload as much as possible. And then for things that I have to do, right? Like I think, wires are very important. Investment, we're wiring large amounts of money to make new investments. And ultimately it's either you get a CFO that's very serious that you can trust to do that, or I think like I should still be doing some of these things. You just find ways to be really, really efficient as much as possible. Like email is one thing that it takes a lot of time. I wake up in the morning, I've got probably 100 emails plus, and I use Superhuman. I have it filter a bunch of stuff. It's super snappy and quick. I use the AI drafting tools for a lot of emails that I can automate a bit more of. And I think it's finding ways to like quickly go through a lot of those operationally important and administrative tasks, but like doing it as efficiently as possible. And I think the benefit also of kind of running your own business as well is you have a bit more, I would say, autonomy in terms of like when you do things. So for me, like I try to get through a lot of my emails in the morning, and also try to like do a lot of stuff at night or during the weekends when things are not as busy, right? So that I can get those things done that I know are important and I should do, but I have control over my own schedule because I'm, not tied to the desk at like investment banking or private equity. And so, I'm not making sure that I have FaceTime with my boss, but that means that I can schedule my time more appropriately so that I get the things done when maybe I have a little bit more free time and I should focus on these specific things at a different time, right?
One thing you'll notice about almost every person working on the buy side is that they started off their careers in investment banking, and that's because it provides the most solid foundation for a career in finance. If you're early on in your career and you're trying to break into banking, I want to tell you about a student I recently helped named David, who landed 4 offers after working with me in my mentorship program, the Banking Accelerator. With every student, we apply our 3-step recruiting formula, and so we started with step 1, which is pairing students with coaches that best fit their backgrounds and goals. David, for example, was a non-target student targeting New York, so we paired him with a coach who went from a non-target to Goldman Sachs New York for all of David's one-on-one calls. His coach then walked him through step 2, which is going from 0 to interview ready by covering recruiting foundations, resume revisions, networking best practices, behaviorals, and technicals. And the best part of the program is that you're never recruiting alone. Step 3 is our community. David attended weekly group calls with me and other coaches and had 24/7 chat support from me, his coach, and other students. Ultimately, David landed not 1 but 4 offers from a non-target school. And if you want targeted help like this to maximize your chances of breaking into banking, book a free strategy call with my team using the link in the description or by scanning the QR code on the screen. We'll assess your situation and let you know if you're a good fit for the program. And at the very least, you'll get some good career advice. Hope to meet you and work with you soon. I guess on that note of there's like FaceTime culture in banking, and when I'm thinking about the word culture and you running your fund right now, you know, you've worked in intense industries, like Apollo is also known for being very intense. I'm sure SoftBank was also like very intense as well. What kind of culture have you kind of built at Mangusta?
Yeah. Actually, I have a funny story from Apollo. It is a very famously intense place. But actually, one thing that I remember a lot, I don't know if you saw it in one of my previous videos or interviews that I did, but there was once I was on a live deal. We were buying Qdoba from Jack in the Box. It was like a very complicated like carve out transaction. And I remember the last few days of the investment committee and the deal closing, I literally slept in the office on the sofa in the lobby for like 2 days straight because I didn't have the time to like go back home. You know, it didn't really make sense for me to go back home because I would have like 2 to 3 hours of sleep. Might as well just nap it out on the couch. But yeah, I guess it confirms, it's a very, very intense, work hard kind of culture. For me, I think we are fully remote, which is kind of interesting. I think even though we're fully remote, we are all like constantly online reachable. So the entire team, like I can pick up the phone and call anyone almost any time unless they're sleeping and they will pick up. Or if I text, we will respond within, I would say, usually within like 15 to 30 minutes, but usually a lot faster than that, but like no later than probably like an hour. And I think it's just part of like the culture of what we do. Like things move very quickly. Founders make decisions very quickly. Deals, fundraising rounds and deals come together very quickly. Investors and LPs make decisions very quickly. Sometimes they're hot and heavy for something, sometimes they're not. And you've got to strike while the iron's hot. And speed is absolutely important here in Silicon Valley too. Like sometimes if you miss out on a deal, it could be literally the difference between like a day or 2 days of getting in touch with a founder, right? So I think that element of intensity when it comes to like responsiveness and just like the velocity of the work that we do is important to me. I think there's a lot of things that are very different from like Apollo or like investment banking, right? I think there's a lot less, I would say, financial modeling, analytical kind of like rigor when it comes to like you have tons and tons of data that you can like sort through. Oftentimes you don't have that, right? You might have a deck, basic financial model, maybe some like customer matrix and like cohort data, and that's kind of all you got to work with. So I would say the name of the game, I think in venture capital more so than private equity and hedge funds, is just getting access to deals, building the relationship that you have with other VCs, founders, building a reputation for yourself as a firm and a brand as well that people recognize, hey, I've heard of Mangusta. Like they've done really great things for their portfolio companies, help them grow. And they're extremely supportive in Europe. I want to work with those guys. They're really sharp. They're really smart, whatever it is. And I think that is the core kind of focus of where we spend our time and intensity is like building out those relationships, strengthening them, doing events, building community, and then moving really fast when we need to around deals as they come together. And so I think it's intensity, but kind of in a different way, right? And I also think, for what it's worth, I don't know why private equity firms and hedge funds and investment banking firms do this, but I feel like there's almost this element of kind of being like very like sharp elbowed and having like a culture per se, like a personality in the office that's like very cold and blunt, where that just doesn't fly in venture capital, right? Like you've got to make friends with other investors, you've got to make friends with other founders that will vouch for you. And same thing, I want my team to be happy and to enjoy coming to work and to be excited to work with me and work with all of our portfolio companies. And there's, not really a place for assholes in, I think, what we do, right? So I do think the culture, when it comes to like personality wise, is a lot more, I would say, I don't want to say relaxed, but it's a lot more like socially conscious, that like we can't be dicks. Like we have to be nice, good people that people want to work with us and people want to support us and hang out with us, because that's just what we do, right?
There's so many, I guess, like questions that come off of what you just said. I wanted to ask about first, though, when you've also mentioned previously that you had times when you're fundraising, you met like contacted or spoke with 1,000 LPs, and then for a lot of your work today, you have to meet with a lot of founders and potentially other investors at times, and it's a very people-facing role. So, and for you, are you more introverted or extroverted? And I've heard from my other friends in VC that doesn't really matter. Like both can do very well. But I wanted to ask about, for you, which one are you, and how have you kind of, I guess, if it's extroverted, then I guess it's obvious that you just play that to your strengths. But if you're more introverted, then I think you have to use that in a different way. Like what would you consider yourself, and do you feel like it makes a difference if you're one or the other in VC?
Yeah, absolutely. So number one, I think extroverts in general, from what I can see in like business broadly, I think have a advantage as an extrovert. I think there's probably quite a lot of, I don't know if there's a bunch of data points and studies out there, but I think people who thrive off of like meeting a lot of interesting people and like communicating a lot and spending a lot of time with other people just innately have an advantage when it comes to building relationships. I am actually very introverted, which is very hard to potentially see when I am interacting in public or when I'm, at an event or speaking at a conference or something. And just like my persona, right? I think I do have energy and I do have a lot of passion for what I do, but I would say that I am very introverted when it comes to like in my own free time. What I like to do is just like stay at home, watch TV, hang out with my dog, hang out with my wife, like not going out and like socializing a ton when it's not something that's like work related. And so I am, I guess, like a trained like extrovert in some sense for my job, right? Because as you mentioned, and as I mentioned, like I had to go out and meet, say, 1,000 LPs. Well, that's a lot of people to meet, right?
Yeah.
And that's going to a lot of events, going up to a lot of strangers. And I think there is an element of, even if you're an introvert, I think it's helpful to train yourself to be an extrovert, from time to time, right? Like you can selectively turn it on and off. You don't have to be an extrovert always, but if you're going to a networking event, if you're going to a conference, if you're going to, something that's like a dinner, like it is helpful for you to make new relationships and contacts at that event, and you need to put yourself out there. And if that's not what you want to do, then maybe this is not the right job for you too, right? Because you have, like in a field like venture capital, part of the job is like you have to build relationships, you have to source deals, you have to source LPs and investors. And it's not easy, but the more you do it, the easier it becomes, right? I was very shy when I was in middle school, even high school, and even college, I would say. But like there were things that I would do which would gradually get me out of my shell. Like one of those things is like speech and debate. I did in high school. I highly, highly recommend for, I mean, I don't know if you have high schoolers or like college students, probably college students watching, but like, highly recommend like public speaking, speech and debate type of activities, just because it like forces you out of your comfort zone if you're naturally a shy person and you have to go out and say something and not be afraid to like make mistakes or say something stupid, right, in front of a big crowd. And that's fine. We all make mistakes. We all learn from those mistakes. And that's part of the process of growing and improving, right? And so I just constantly kept putting myself in those situations where I'd be, vulnerable and I would make mistakes, but I'd learn from those opportunities. And I keep doing that even now too, right? I'll go speak at conferences, and you try to prepare as best you can, but it's also just an opportunity for you to practice putting yourself out there. So yeah, I mean, it's a fascinating question because like I think it on one hand it's like a question of like, can you change who you are? And I think in some ways, like, yes, I think you can, we're all very moldable and our skill sets are very transferable. And, you should do, and I find, I will say another difference is I have a lot of energy when it comes to like talking one-on-one with people. I think I don't like being in kind of larger group settings and having to like spend a bunch of time in kind of larger groups. But when it comes to like one-on-one conversations, I find that I can go for like hours with talking to one person if there's like a really interesting thread or conversation here. Because I think it's just really interesting to like learn about someone else and hear what they have to offer and what their life experiences are. And so I often find myself asking a lot of questions to like even LPs that I meet because I want to understand who they are and how they think about the world. And it also helps me figure out, hey, is this someone that actually, is probably interested in what we're doing and, I want to spend more time on? Because part of the thing I learned about sales and fundraising is it's actually less about pitching, it's more about listening,
Mm.
right? You have to listen to what does this person care about? What does this person want? And is what I'm offering aligned with what they want? Because if it's not, there's no amount of pitching that's going to get them over the line, right? They're just not interested in what you have to offer, and that's fine, right? That's a great way to say, okay, I've put in enough time and effort here. This is probably not necessarily a good lead for me to continue following, and let me go and find another lead that I can go, follow, right? But it's helpful information for me to know what does this person care about, and that only comes by listening and asking questions.
Yeah, that's kind of similar to what I said my friend in VC who is an introvert. And when he went into VC, I hear a lot of the times that in VC, you have to spend your times like meeting people all the time and whatnot. And so I asked him about it. And I feel like he said something similar to you that you can play to your strengths as an introvert by kind of like being a good listener and being more in tune kind of when someone else is speaking, leaving more room for them to speak. And I would imagine that there are a lot of people who are VC investors who are, very maybe like loud, really good with people, which is great. But then when it comes down to a one-on-one conversation, yeah, when you're trying to convince maybe a founder or investor to work with you, they don't want to hear you talking all the time. They want
Yeah.
to be the ones talking and you're kind of listening, I guess.
Yeah.
So that makes a lot of sense. And I think we kind of strayed away a bit from what I wanted to talk about at the beginning, so people could have more context, which is kind of like your experience in private equity and at your hedge fund and at SoftBank, which is a bit more growth. So I wanted to kind of shift a little bit there, and then we can, I guess, go back into VC a bit more. But one thing that you've talked about in your previous interviews is that at Soros, you kind of learned how to take chips off the table and sell down into appreciation. And so I wanted to, there are not a lot of people who can talk about their experience like at a hedge fund. So I wanted to kind of first focus on that lesson that you learned. And if you could walk us through maybe like a specific trade where that kind of lesson got drilled into you.
Yeah, no, it's a good it's an interesting point, right? Because in most private investing, whether it's like private equity or like venture capital, you typically don't have an opportunity for liquidity every day, right? You enter an investment, you hold it for a number of years, and then you do an IPO or an M&A. But that exit is kind of sometimes it's out of your control, and sometimes it takes a very long time. With a hedge fund, you are looking at your portfolio every day, and you can decide to buy more or sell every single day. And so the world of possibilities is open to you, which makes things honestly quite hard too, right? Because you have a choice to make every day. Do you buy, sell, or do you hold it? And one of the things that the PM that I work with at Soros always said was, when a stock goes down, it's very counterintuitive, right? Because in some ways it's like kind of going against what the market is saying or doing, which is if something goes down, if a stock goes down in price, but you still believe in the thesis and you still believe in the upside, then you should buy more, right? So something goes down, you buy more, and you keep loading up on more stock of something that you believe in. And then similarly, if something goes up and it hits, say, your target price, say you buy whatever, Apple, for example, and it goes, doubles in stock price over the course of 3 months, and you're like, oh, this is great. Like, this is where I thought it should trade. Well, then if it reaches your target price, you should sell out of that position as it gets to your target price, right? Theoretically, once it reaches your target price, if you are accurate and you have a lot of confidence in the analysis that you've done, then theoretically you should sell out of your position entirely by the time you get to your target price because you don't think it's going to go up anymore, right? And so that way of thinking is something which I also try to bring a little bit into venture capital, because I think that there's venture capitalists, I think, are very good at entering positions and investing in picking companies. They're very bad at exiting companies. And they often don't really think at all about exiting companies, right? They just kind of let it sit there or hold it until it either dies or it IPOs. And I think taking a little bit more of an active approach to managing your portfolio and positions is very helpful and thoughtful, which a lot of VCs don't frankly do. So when I bring it up with LPs, they actually really like that because they're like, oh, this guy actually has spent some time investing in other things rather than just being a VC for his entire career, right? But it's one of the lessons that I took away from kind of my hedge fund experience. And I think if you talk a lot of hedge fund folks, they will probably say something similar, that it's important to kind of add and trim to your positions as you gain conviction in the price of an opportunity, or you lose conviction in the price of an opportunity.
But how do you think about that where in hedge funds, there's a ton of data and you can build models that are quarterly, even like monthly, maybe even weekly if you have the right information. I guess in VC, if you have access to it with your portfolio companies, then you can get that data as well. But then ideally, when you're at the early stage, the growth is supposed to be kind of explosive. So then I guess the two-part question is, first, how do you sell into appreciation and build the confidence when your models, which famously, any model you build is most likely wrong because there's just so many things that change. So then, like, how do you think about in your current role in VC actually feeling confident, oh, we should sell into appreciation when things are supposed to explode the earlier you're in, so you may like lose out on potential gains. How do you model that out and think about that?
Yeah, it's a good question. So I would say for us, we underwrite like every investment we make, we underwrite to at least a 10x opportunity, and that's our base case because that's what we've told our investors is kind of what we expect the return of the fund will be over the course of the fund life. And so every investment, our base case is at least 10x, and then the upside case can range, but usually anywhere from whatever 20x to maybe 100x plus, right? I would argue that if if a portfolio company of ours has performed so well that they've reached kind of the upside case scenario that we modeled out, I would say whether it's whatever 20x, 50x, we should take some of the chips off the table, right? Doesn't mean that we have to take all of it off the table. Like we're not going to sell 100% of our position, but if we can take 20% of our position off the table, a quarter of our position off the table, and then we return some equity, return some cash and dividends to our LPs, I think that is a very prudent way to manage money because we don't know where the world will be going, next year, 5 years from now. We could be in a global pandemic. And if you invested in a business that does travel, it's going to be it's going to be a really tough path, right? But if you can take some chips off the table and if you sell, whatever it is, 20% of a position that's gone up 10x, 20x, you're going to make still a very, very good, you're going to return the basis of that investment at least, plus probably some upside on top of that, right? And I think there's very few LPs out there that will be disappointed or angry that you liquidated, 20% of a position that's gone up a ton, because they also want to know, hey, you're thinking about my capital as if it's your capital, making sure that we return at least our basis, and setting at least a foundation, right? A financial foundation of like, hey, this is, we've already returned your basis in the fund. So you can know that like your capital is at least preserved, whatever, 1x. And then on top of that, we still have 80% of the position that still has upside exposure. And so I think for me, there is obviously an element of like, oh, say that it becomes 1,000x one day, then, you lost out on 20% of 1,000x. Yeah, that's true. But I think in a lot of these scenarios, I feel much more comfortable with telling our investors like, hey, we are very prudent, fiscally responsible managers of your money. And we're going to make every effort we can where we think our target return or upside return has been hit for this specific investment. And we want to take some money off the table and return it to our investors.
Okay. That makes sense. And so that sounds like a very important lesson you've implemented from your hedge fund days. I was wondering maybe also from your private equity days. Was there anything that you learned from there that you also applied to what you do today?
It's a good question. I would say there's not as much that's, I would say, directly applicable, perhaps. Because I just remember in our private equity days, a lot of time was spent on financial modeling and really detailed drivers and assumptions in those models, which obviously we don't do as much of in early stage or growth stage venture capital. And the second area we spent a lot of time on was negotiating legal documents and financial kind of accounting documents or working capital pegs and things like that, which obviously we don't also negotiate a lot in venture capital either. So I feel like there isn't a ton that's directly applicable. The only area that I think is interesting, I would say, is just the element of relationships and deal making. I think making deals happen and making investments happen is just a highly personal, especially private transactions happen. It's a very relationship driven business and it's a personal human to human kind of business, right? And I think, regardless of what you think about Apollo, I think that there was definitely an emphasis on like relationships, building good relationships with good operators. And if they can help you come in to run a business, fix a business, like they would often bring in the same CEO if they were just a rock star to run one business. And then, that does well. They bring them in, the same person in to run another business. And just finding good people to work with that you trust and trying to make those deal opportunities is something that, I do bring into what we do here. Obviously, it's a little bit different because instead of dealing with probably like more middle-aged kind of, professional business professionals of like almost public companies at private equity, usually we're dealing with kind of 20 to 30-year-old young founders here in Silicon Valley. So it's different ways of building relationships and getting to know someone. But in a similar way, you're really trying to find a connection with someone and making the relationship such that you believe like they're going to be someone that you can count on, that you want to work with. And it's a long journey, right? If you invest in a startup and you join their board, you're with them for the life cycle of that company, which can be 3 year, it can be 1 year, 3 years, 5 years, 10 years. And so it becomes a very, very long-term relationship that you build. And that's something that I really enjoy about what we do as well.
And it seems like honestly you didn't enjoy the PE part too much. I can also maybe gather that for because you stayed there for just 1 year. But was there a big reason you decided to make the move? Because a lot of people obviously after banking they go into PE. That's kind of what they want to do, and they're there for like at least a few years and then maybe move on to something else. But was there something that caused you to want to move into hedge funds?
Yeah, there were a couple of things. And just to be clear, by the way, I joined, so I was at Apollo for about a year, and then I joined SoftBank. And then hedge fund was actually in the middle of my time at SoftBank.
Oh,
So
okay.
yeah, it's a bit of a strange journey. I joined Soros for 1 year during COVID, kind of just as a way to try out the space. But the transition from private equity to SoftBank to more like growth and venture, there were a couple of things that really influenced my decision there. One was when I was at Apollo, no offense to Apollo, but the way that they think about private equity investing is very value oriented, right? Almost in some cases distressed oriented, where they're looking for a cheap multiple, really good cash flow, and an opportunistic transaction where for some reason this company or this business has fallen out of favor or has self-inflicted some big issues in itself. And I think they've performed very well as a firm, right? They've obviously become one of the best firms in what they do. But for me, it wasn't as personally exciting to be investing in and kind of helping turn around businesses that were really, really struggling. Sometimes because it was just a fact that their industry or what they did, their business model was starting to become more obsolete. I think there was one business that was like Chuck E. Cheese. And I used to love going to it as a kid. But like there are just so many trends against it. Healthier foods, like other, sorts of recreation, not indoor and, such a space. And COVID obviously was also not a great not a great thing for them as well.
Yeah.
But it just felt like the businesses we were investing in were not going to be the businesses that would be around for like the next 5, 10, 20 years. And so I think for me, a big part of it was, do I want to be working with the businesses that will be growing in the future or just kind of helping these businesses that will probably sunset over the near term and just extract some value and cash flow out of it over the next few years? So that was one thing, is just kind of like a philosophical, perhaps, difference in how I thought about investing and what I personally want to invest in. And then I think the second thing that I felt really influenced my decision was I thought about like, what do I think I'm good at? What do I really want to be doing with my time? And is it, sitting in front of an Excel file and a really complicated financial model and making sure that all the drivers are really buttoned up and there are no busts in the model, and negotiating legal documents for hours on the phone with lawyers. And don't get me wrong, some people love that. Like there are plenty of graduates from, for example, there were a lot of Wharton graduates at Apollo, both undergrad and MBA grads, and I think many of them genuinely loved doing the accounting, financial modeling, legal due diligence, and negotiations, and they just really enjoyed that work. And that's fantastic for them. I think private equity is great for them. But for me, I just realized that's not what makes me excited to get up and go to work in the morning. I want to like meet interesting people. I want to learn about really interesting new spaces, new markets, new technologies. And I felt like I really wasn't getting a lot of that like relationship building or kind of networking and sourcing experience. And you won't really get that, I think, in private equity until you get to like a senior level as a partner, or maybe as like a, whatever, junior partner, principal level in private equity. Like, unless, or maybe if you're at like a mid-market firm, that's different because there are probably more sourcing models involved there. But at like a large private equity mega cap firm, like the sourcing and relationship building side of things really only kicks in once you're kind of like a senior level person. And so I felt like, well, I could try to grind it out for the next, whatever, 5 to 10 years and see if I can get to that. Or I can just put what I think are my strengths and what I want to do to practice today and actually try to do that in venture growth, which is what I ended up deciding to do. So it was, yeah, I think it was, both of those kind of elements that I thought about, which takes a while. Like I've always believed trial and error is the way to figure out like what you enjoy, what you're good at, and where the world is going. Like those are the three things that I always triangulate for. Is like, where's the world going? What do you think you're good at and can excel at? And what do you enjoy doing? And if you find something that kind of hopefully matches those three things, I think that's like a recipe for like career success and kind of happiness.
Mm. Yeah, I like that framework. I'll definitely have to think about that more myself as well. I So you went from, I actually probably looked at your LinkedIn wrong because I think I saw Apollo, then Soros, and then SoftBank, but I didn't look at the years or something then. So then you went from Apollo to SoftBank's Vision Fund, and everyone knows that they started the $100 billion fund, and you were kind of there in the early days in the second year or so. Is that right?
Yeah, I think officially maybe started in like, I don't know, 2016, but it was announced pretty publicly in 2017. And that's 2017, 2018 is where the team did most of the hiring and growing, like did the most growth, I guess.
And so when you were there, because as we talked about before, we actually began speaking, like I went through the interview process when I was back in banking as well. And so I remember during that time, a lot of people were being like hired, and it was a pretty exciting opportunity. And when you got there in the first few weeks, like how was, the first few weeks there, first year there, like what was that like?
Yeah, I mean, the way that I kind of describe it for people is like think about being at a really well-funded startup. And that's kind of how it felt for like the first year or two. Like one is in the beginning, we didn't even have titles. They were like, everyone was an investor. And then they had HR, then they brought on an HR team. They had to standardize titles. They also had to standardize compensation. I think for a while they didn't even have standardized compensation levels, which like most private equity and investment bank, like most finance firms have a very, very organized like compensation and title structure for every single level. And so over the first like 2 to 3 years, it was just like everything was being built, like the boat was being built as we were going, setting sail, which was kind of cool in some ways because I think it allowed people to basically take on much more responsibility than you would typically get. I was technically like a senior associate when I first joined, and I was like running deals as if I was like the managing director or like a partner on like a traditional kind of like whatever growth or private equity fund, because I would be like helping negotiate the term sheet, and I'd be like, presenting in front of the investment committee, which typically like you don't usually like the deal partner or like the lead partner is like presenting the deal, right? So I think it was just a really unique opportunity for me to and for everyone and in those early days to just get so much more career experience and acceleration in learning that you wouldn't really get somewhere else. And that's the beauty of joining a startup too, right? If you start your own startup or you join a startup, arguably there should be more opportunities for you to step up and push the boundaries of your own skill set, because they want everyone to do as much as possible. And so for me, like, I remember there was one time I was presenting, I brought a company to Masa, who is effectively our investment committee. And it was like a robotics company, and Masa really loved the company. So at the end of the call, he was like, he looked at me and he was like, Kevin, you need to get this deal done. Like, get this deal done. We need to invest in this company. I'm like, okay, yes, Masa. Like, I will do this for you. Like, I understand. Like, and I'm like, oh my gosh. Like, if I don't, am I gonna get fired if I like don't get this deal done? Like, is it over for me? There's a certain level of like pressure. Like, in some ways, it's obviously great to like get that experience of like, interacting with basically the CEO of one of the biggest investment firms in the world. But on the other hand, like, you feel a lot of pressure and intensity of like your neck and is on the line, right? Like, you're really responsible for this. So it's like exhilarating and like terrifying at the same time.
So how did the meeting cadence work in terms of like maybe with Masa, or like did you guys, because there are different like pods almost in SoftBank, and you guys all kind of were
Yeah.
managing different things. I've also heard that at times it didn't feel as much investing because it sometimes be like Masa wants this and this and this, so we're just gonna have to like do what he wants. But I guess you mentioned in your example that you had brought an idea to him. So I guess how did the meetings work? How did the investment decisions work
Yeah.
in the fund?
Yeah, so it changed over time, but generally, in the heyday of like when we were very active, we would basically have a meeting with Masa every week. And so he would do like I forget what day of the week it was, but think of it as like a Monday morning kind of meeting where we would run through the pipeline of whatever people were bringing forward to him. And then there would be investment committee where you get official approvals. And in the very beginning, before COVID happened, we would actually fly out all the founders to meet with Masa in Tokyo. So it was crazy because sometimes you literally fly a founder out for like a 30-minute or 1 hour meeting, and then you fly right back. And you'd usually try to like tag on some other meetings and maybe stay for a weekend if you could, because it's a long flight, right? Even from the West Coast to like Tokyo. But I remember like we would be bringing, Masa always liked to meet the founders in person. And so we would try to bring like at least one or two founders to meet with him every month. And there were about 5 or 6 teams at the time that were kind of structured like pods. So there was one managing partner who would run their own pod. And so think of like 6 different pods that were each bringing forward the deals that they wanted to do. And there was an element of both of the things that you kind of mentioned, right? There was some element of if there's a managing partner that really liked a particular founder and deal, they would bring it forward to Masa and kind of, have their own conviction and agenda with wanting to do that deal. There are also cases where Masa would say, hey, I really like this company. Like, can we get in front of this founder or this company? Or he'd say, I really like this space. Like, I want to do some more robotics investments, for example. And people would go crazy and be like, okay, I'm going to go source this robotic company. And then, inevitably there'd be some kind of overlap because this team reached out, that team reached out. So there's also like a decent amount of like chaos when it came to covering different areas and different founders, but through multiple different teams. So a lot of interesting, so many interesting stories from SoftBank times. But all in all, like I still feel like it was a very great learning experience for me and for a lot of us because especially when you're earlier on in your career, like you usually don't get to meet and take on that much responsibility.
You kind of mentioned a little bit that there were a lot of great stories from SoftBank. So yeah, I was wondering if you could share any that are particularly interesting. Also, people love hearing stories about Masa as well.
Mhm.
So anything that comes to mind that you feel like would be like fun, entertaining, insightful, educational.
Yeah, I mean, there's just so many funny stories about him. I mean, I think there's a couple. I'll start with maybe a couple of things that are like I respect and think that he's one of the best in the world at. I think one area is like he is the most charming person that you could ever imagine that like a relatively short like Japanese gentleman could be. Like he has a really good sense of humor. He like makes Star Wars jokes. He's has this like presence or like aura about him that's just like gets people. It's like kind of mysterious, but in a way like because of it, people think that he's like a genius. And I think he's just like a really good storyteller and very charming in the way that he does it. And I think the best kind of manifestation of that, that proves that fact, is that it's not easy to raise $100 billion, right? And the fact that he was able to do that is like I think a testament to the capabilities that he has as kind of like a charming like storyteller and like as a salesperson, honestly, right? So I think that's like the first thing that I would put out there. He's like super optimistic. He understands the art of deals as well. Like one of the interesting things that he used to do a lot, including in one of the deals that I worked on, when he's in a meeting with a founder in person and he likes it so much, he will effectively either write on the whiteboard a term sheet. So he'll basically say, I'm going to invest $1 billion at, 4 billion valuation. We will have, JV in Japan. We will help you expand here, and we will close this deal in the next 2 weeks. And he's like, I sign here, you sign here, on the spot, like after like, a 30-minute, 1 hour meeting with the founder, or he'll do it on like a napkin. So we used to have these, it was like the craziest thing for our legal team because we basically like, he would write the same thing on a napkin and they would sign the napkin. And then we would have to take a picture of the napkin and send it to our legal team and say, hey, we need to draft a legal document that reflects what is written here on this napkin. It's like, this is a term
Crazy.
sheet that was written on a napkin. Now make it legal and
Mm.
binding.
So then, even though all the details aren't on there, so I'm sure like after that, would there still be a lot of negotiation or like because is it more
Yeah.
symbolic or
Yeah, in some ways it's symbolic, I guess. So like, obviously a napkin is not a binding, document with like five scribbled words on it, right? But I think in a lot of ways it set the stage, it set the most important details of like here's the valuation, here's how much we're going to invest, and like at least you've gotten like the big things out of the way, right? So
mm,
there's not a lot of negotiation on those bigger points, but obviously on the finer details, like maybe you want to negotiate when the deal closes, or like, is the valuation fully diluted? Does it include like an options pool? Like, there's some finer details you can hash out, but at the very least, you get like the big details sorted out with the napkin, right?
mm,
And I think it also just represented like Masa as a deal maker, right? He understood the art of like if there's something that's really hard to get access to, or there's a founder that he really likes and he really likes this business, he knows that like you've got to pounce and you've got to strike while the iron's hot. And
mm,
the moment when, part of that is kind of like an intimidation. I feel like people are charmed when they get flown to Tokyo and they meet with Masa, and it's a huge boardroom, and he's got this presence around him, and then he's got his like entourage of like 5 or 6 advisors that are sitting around the table, and you just feel like you're gonna make the deal of your life, right? And so it's also a great opportunity for Masa, I think, to basically say, here's the deal. You need to sign this now if you want to be like the next Nvidia or the next like DoorDash or Uber, like you should sign this deal right now with me because I'm going to make you a superstar. So I think when I think about it, there was also this kind of like reverse salesmanship that he was doing with the founders, where he was like striking while the iron's hot and also getting them very excited about partnering with Masa, right?
Interesting. Okay. Yeah, I mean, I can imagine being a founder in that situation, as you said, being flown to Tokyo and then meeting with him, and then all of a sudden you're just like signing this term sheet on it. It almost sounds comical, but at the same time, it's like fun because of that, and all of that I'm sure like pulls together really well to ultimately like get deals done, or at
Yeah.
least the deal process started. So you've kind of mentioned before in other interviews that Masa was like, and as you've spoken about, he was like a big influence in terms of like dreaming really, really big. So I wanted to ask for you and Mangusta, like how big are you trying to build the firm into?
Yeah. I mean, that's a good question. And it's one that I think about a lot myself because, the first thing I'll say is bigger is not always better. And, it's something that I want to be very thoughtful about because when I think about what's the North Star when you're starting an investing firm, I don't think it's about building like the biggest fund possible, right? I think for me, my North Star is I want to generate the best possible returns for my investors and to help them achieve whatever their goals may be, right? Most of our investors are financial investors, in which case, investment returns is probably their North Star as well. But, for some, like maybe they have strategic goals where they're learning about AI or they want to implement AI into their, businesses that are more legacy businesses, and we're helping them get more educated and more exposure through kind of investing and learning about these assets and technologies. And so for me, when I think about where we want to take this, I think a part of it is like growing in a reasonable, thoughtful way to continue to achieve those goals of like providing the best possible returns to our LPs. But at the same time, like, I do want to build, I think, a generational kind of firm and a platform that I feel like captures the essence of like who we are and who I am as kind of like a founder and entrepreneur as well. Which means I think hopefully getting, bigger over time, but with a focus on continuing to find like the best hungry entrepreneurs who want to partner with us and who like we want to change the world with. And so I think, we'll start with fund two, it'll probably be bigger than fund one. That's, whether it's, 2 times larger or something else, we'll see. But I think it'll be larger than fund one. I do think we are going to do a bit more growth investing just because the way that the markets have been evolving quite recently with AI and tech investing. I do think a lot of the best opportunities almost jump to kind of a growth stage very, very quickly, at least in terms of valuation. And those are often the teams that are best equipped to like succeed in what they're doing. And so I think we need to adapt to where the world is going. And I think that part of that involves being willing to play a little bit later stage as well, which plays in very well to kind of my SoftBank background and network too. And then over time, I think we'll see where the world takes us. I think there always are thoughts about, the secondaries market is a very interesting one that I've also thought about potentially doing more in the next kind of 2 to 3 years if we have the right people and the right platform for it. and yeah, supporting other kind of emerging fund managers. Like I think there's a lot of really, really interesting funds and a lot of very close friends who are, also starting funds. And I think there's ways that I want to work with them as well to help support them. So a lot of different ideas that we're exploring, but I think for us, the focus is going to be on Fund 2, making sure that we do a good job with performance there and finding great companies and great LPs to partner with. And for me, it's a bit also like not really thinking too far ahead in terms of like, what is necessarily like the end goal. I think a lot of how I want to like build things is like one step at a time. Cause like I think you can always see maybe like a year, 6 months to a year in the future. I think you have good visibility to like what you want to do, where the world is going. But like when you think about like 3 years out, 5 years out, 10 years out, it just becomes a lot harder because there's so many different variables at play and the world changes so quickly that it's hard for me to say like where do we want to be in 10 years. Like who knows, we could be in space, maybe we'll be starting a space colony fund in Mars or something, and there's no way that I would be able to predict that today.
Yeah, yeah, yeah. That makes a lot of sense. I mean, I also think back to my own life, and I think the exact same thing. I thought my life would turn out a certain way, and then here I am, like running a YouTube channel, talking to you. When I started off my career in banking, thought I'd be in like a normal finance path, but I think we've covered so much, and I just had a quick last few questions for you though to
Yeah.
kind of pick your brain a little bit. One is, since you invest in so many AI companies, I wanted to know a bit about your own personal like AI stack and like what products you use and you think are kind of like the best out there.
Yeah, it's a good question. So I will say with a caveat that I'm probably not the most how should I put it, like technically oriented like GP out there in terms of like testing out a lot of the latest like AI tools. Like I know a few of my fellow like emerging manager friends that actually have built like their own like OpenClaw agent, and they bought like a MacBook whatever, it's like a Mac
Mini.
Mini, and
Yeah.
they like booted it up with everything, and it's crazy. So I have not done that, but what I do use AI for, I use it a lot for, I would say, email drafting, document review when it comes to like agreements, sometimes like just preliminary legal doc review as well. A lot of like memo writing and drafting when it comes to that too. We do a decent amount of kind of like due diligence memos, IC memos. So I usually use Claude for that. Honestly, I find a lot of them pretty similar. I would say Claude is maybe like slightly better, but I use like Gemini, I use GPT as well. Like I find them pretty interchangeable, honestly, for things that I'm doing, which are not super, super advanced. I do use like, from time to time, I'll play with like Replit, which is also one of our portfolio companies when it comes to like thinking about changes to our website, and like helping like code very simple apps here and there. And then aside from that, like not really that much, to be honest, that comes to mind. Like we maybe a little bit of like editing software, like video editing stuff. Like I started doing talking head videos as I talked about. Like I'll use like CapCut and stuff for that. But I don't count it as like really super hardcore AI tools. We are also going to experiment. We're starting to experiment with some interesting like CRM, AI agent oriented like CRM tools, because we use Affinity right now, which is a very common like VC CRM system, but it's quite expensive, and it's a very like legacy. It's like an Excel table online where you like fill in each of the cells, and like it's okay, but I've heard that now there's like these AI agents which you can like literally give them commands and it will go and do the things that you want, like send a bulk email to these people or whatever it is, and you can like have a conversational CRM effectively. And so that's something that we're going to try out as well. So we're always looking for like new tools and tech stacks that we could use that will help us with what we're trying to do. But my general view is like if something is working pretty well for me, I'm not necessarily going to switch unless I see a huge ROI from it.
Gotcha. Okay. And then last two questions. One is, you're a founder and you have to hire a lot of people. You also interact with so many people. So you have like now you've built a pretty strong radar, I would assume, of getting to know someone pretty quickly. So let's say you're hiring someone. What kind of interview questions do you like to ask and look for in people you hire?
Yeah. So this is an interesting question because I actually don't believe that interviews are a great way to hire people. If you can do it and if you can afford to do it, I like to have people do like a trial period. And so just think of it as like someone works with you part-time for a month or two. Obviously, it's hard to do if they have a full-time job that they're already at. But I find that the best way to figure out who you should hire is by actually working with them for some period of time. So we try to do that a lot here at Mangusta as well. Like most of the full-time folks we have started out as like part-time trial folks. But in terms of like interview, I would say like we obviously try to do interviews in the first few kind of meetings to decide if we want to bring them on and help them, have them do a trial period. I think one of the things I really look for is I would say like competitiveness. I want to know that someone has a certain level of like drive and hunger to like succeed. And so I'll probably ask like, what's like the most competitive thing that you've done, in your life? Or like, what were some like highly competitive activities, whether it's sports or some other activities like chess, whatever it is, something that someone just really got very passionate about and really wanted to succeed in. Because frankly, I think most people, there's like a smart enough bar that I think most people pass. And after that, it's basically like, do you have the drive to continue to succeed and push yourself and improve? And I can teach someone almost anything that they need to learn for venture capital. It's not rocket science, but I need to know that someone's going to really push it hard and be willing to like put in the effort to grow and succeed, right? And so I think that's like one of the key things that I look for. I think the other thing is like, depending on what role that you're hiring for, obviously you need to ask technical questions if you're hiring for a very technical role. But for me, I think the other area that, I really look for is like responsiveness. And that's something that you get from just like little strange tests here and there, right? Like responsiveness or what I call like being always on. And so like there's a couple of things that I test for. So one is like say that I send you an email asking for like your resume or something. Like how long does it take for you to respond? Say that we do a Zoom call and I say, hey, why don't you shoot me a text afterwards? I'd love to like, we should connect more closely. So like send me a WhatsApp or iMessage. Here's my phone number. See if they do it like after the call and like how long it takes. And like we like people who are very proactive. So it's like, like if you read something interesting, like let me know if you see any interesting news next week about AI or tech. And then sometimes also like if you provide options for like scheduling a call, I can provide some options that are weekdays, provide some options that are weekends, provide some options that are like later nights. And so I get a sense of like, does this person, are they willing to do a call on the weekend? Are they willing to do a call late at night? Like, are they willing to push like that they're willing to do work outside of like regular business hours? Because, if you're doing a startup or you're starting a startup fund, like you want someone who's willing to put in the effort, not just during like a 9 to 5, Monday through Friday, right? So it's like a lot of these like small things that I honestly look for that may not be the most conventional questions.
Yeah, I like those. All of those tips. One you said about trial trial work. That's something that I've also learned kind of the hard way of like working with people, letting them go. And that's what I actually try to do now with all the people I work with as well. And then the competitiveness, responsiveness thing, Honestly, mostly a lot of times, I guess like maybe in your field you do, but the whole competitiveness, it's almost the opposite of what people kind of openly talk about nowadays. Because I feel like a lot of conversation has gone more towards good work-life balance, like work is not everything, et cetera, et cetera. But then I guess like both of us have a banking background where it's like we're the type of people who would think about that a little less than like let's say the average person.
Mm,
But I think that was like super interesting actually to hear how you think about that.
yeah.
The last question I had for you was the question I always ask at the end, which is, there's a lot of people who are listening and watching to this who are going to be in college, and if you could speak to your younger self and kind of give young Kevin some advice, like what would you say to him?
Yeah, no, it's a really good question. It's been a while since I think I've been asked that question, but I used to get asked it a lot actually. Um, I think the main thing I would say is try a lot of different things that you're interested in and try to figure out as fast as possible what you want to do. Because for me, I think the faster that you get to what it is that I don't want to say like everyone is meant to do like one thing, but I do think people all have different strengths and weaknesses and things that they're good at, things that they like, things that they don't like. And the faster that you can figure it out, the faster you will be in a position or in a role where you are destined or best set up to succeed. I think a lot of people kind of follow the path of like, oh, I'm going to do banking, I'm going to do private equity, I'm going to join a hedge fund. Like, especially probably a lot of your listeners, they may fall in this category of this is the path. And I think that's fine to a certain degree. But at each step of the path that you take, try to like be introspective and think about, am I good at this? Do I enjoy this? Because at some point you will have to make a decision that like, if you don't enjoy this and you're not good at it, you probably should do something else. Because either someone's going to tell you, like the outside world is going to force it upon you to like do something else, or you will feel so unhappy and unfulfilled that you will decide yourself to do something else. And the earlier that you get to that realization and hopefully try to figure out what it is you are, I don't want to use the word destined, but like more like fit to do, like what is a good fit for you, I think the sooner you will hopefully, take off to the moon and actually be really successful in what you do. Because if I had started out, if somehow I'd figured out that I wanted to do venture capital and this type of investing straight out of college, you know, I think there would be so much more time that I could and opportunities that I could have invested in like some of the companies that unfortunately like at the point in my career it was already too late for, right? Like I think like, Uber, for example, was probably one that if I had found out earlier, I could have, if I was in a VC role earlier, I might have been able to like get into companies like that, like Stripe and things like that. Like there are a lot of companies where the window of time is just very fast and things move very quickly. And so the faster you get to what it is that you really are, I don't know, meant for doing, I think that's like a huge advantage. And if you can just trial and error, test a bunch of different things, do a bunch of internships, bounce around. I think it's completely fine when you're young. Like no one's going to hold it against you if you spent like 6 months here and another 6 months there. I think that is probably the advice I would give to like try to find your forever home fast.
Yeah, I mean, I would echo that a lot as well, having tried a bunch of different things over the past decade for myself. I guess we'll leave it there. Thank you so much, Kevin, for spending this time. I'm sure you have a lot of people to meet and uh, people to speak with, and you're quite busy. So I appreciate you making the time. I'm sure everyone who's listened also gained a lot from the myriad of different experiences you've had over the past since college, basically.
No, thank you so much, Ben, for having me on. Like, again, I have a ton of respect for this platform that you built and super excited to be able to get on here and talk to all your listeners. And hopefully we can do it again sometime in the future too.
Yeah, sounds good. Thanks so much, Kevin.
Alrighty, take care. See ya.
Bye. All right, so that concludes the episode with Kevin. I actually try to keep these episodes to 1 hour, but there was so much to talk about, and I feel like we just barely scratched the surface. Let me know in the comments if you enjoyed this episode. And with that, thank you all so much, as always, for tuning in, and hope to catch you in the next one.